Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap that we do here each and every night on the membership side of our blog. And what we do is we go over all of the opening and closing or adjusting trades that we made during the day. That way all of our members know exactly what we're doing each and every day as we kind of go through the weeks and months here. So if you have any questions or comments, as always, please add them below the video. I'll get back to all of those tonight and tomorrow before the market open. Today we had a really busy day as we're getting very, very close to February expiration. I believe we got most of what we needed to get off of the portfolio today and closing out the ones that are losers. Also took some nice profits on some other ones going into February expiration here tomorrow, Friday. So if you don't have a lot of your positions exited, I would highly suggest you start getting out of those ASAP. We've only got basically 1 day left to exit all those positions before you start getting assigned if you already haven't been assigned. And then we just had one opening trade today. So I want to cover the opening trade alert today just so we can get that one out of the way before we go through all of the closing trades. And that was this vertical put spread on Verizon. So Verizon actually was a little bit of a bear because I have been wanting to get into this put spread now for a couple days and just can't seem to get the pricing to fill. And I've been working on this trade, and lo and behold, Verizon pops much higher today, but implied volatility still was very high, so it was really easy to get into this trade, unbeknownst to me, at the end of the day when it was riding higher on pricing. So we got into the 46.45 put spread, and we took in a credit of 28 cents per vertical. Now, we did a little bit bigger position here only because we need a little bit more positive delta to our portfolio. Now that we've taken off a lot of trades from February, we need to start kind of rebalancing our deltas in our portfolio. And I got a little bit way too negative, and that still should be okay. I'm still negative right now, and obviously we need the market to have a little bit of a correction here to keep its sanity. But I also want to start adding some positive delta to the portfolio going forward. So sold 8 of these vertical put spreads. They're $1 wide, and we took in a credit about a third of the width of the strikes, which is usually what we target. So if we go to the actual chart here of Verizon, you'll see we had this beautiful pop-up in Verizon today. And like I said, I've been trying to enter this trade for the past couple days, so it would have been even nicer had I gotten filled, but I guess that's the name of the game. So we're down here below the market, the 46.45, so we definitely have some room between us and the market. If we actually go to the trade tab and you guys see exactly where our position is, as always, on the bottom left-hand corner of the screen is our exact position. So you notice the live trade already up about $8, woohoo. But right now you can see our position is at the 46.45. And what we do is we target that probability level to be about the same as the credit that we're receiving. So you'll notice here that the probability of Verizon going down to 46 is about 35%. Now, we didn't take in $35 in credit, but we took in very close to that. So we took in a credit of around 28 cents, which actually moves down our break-even point a little bit below 46. So you kind of have to extrapolate here on the probabilities and get a little creative in your mind. But our break-even point is actually 28 cents below 46. So that means the probability of getting to that level is a little bit less than the probability of getting to 46. But you'll notice that usually when we make these trades, and I'll try to point out this a lot more going forward, but we're trying to match our risk to the probability that we're actually taking. So if I'm taking on a trade that has a 60% probability of being out of the money, then I want to get compensated appropriately. And really you can only do that by trading the right direction and the right volatility, i.e. you're not trading and selling options during low volatility and you're not buying options during high volatility. So this is a really key point that I want to drive home about understanding your exact risk for reward that you're getting compensated for in your credit spreads. All right, so let's move on to the closing trades that we had here today. We unwound our entire Twitter position. Twitter was kind of all over the map today, and for part of the day was right where we needed it to be. It just didn't close there. We needed Twitter to be right around this 55 strike that we had a lot of positions at. And like I said, during the day, it opened up higher than 55, came back down, and actually traded below 55 for a little bit, but then rallied up at the end of the day. But we closed out this position. What ended up being a very, very advanced position, i.e. we had a lot of adjustments, a lot of rolling and hedging, and what could have been a couple $1,000 loss, at least with the position size that we were trading, ended up being not too bad of a loss. We actually cut our loss almost about in half, a little less than about half of our loss by just making those adjustments in those rolling trades and being a little bit nimble as we get closer to expiration. So again, with Google and with Twitter, I'm going to do a long post on those later on in the blog. I just got to get all the data together and kind of run through it. But I'm going to be posting that later on, so check it out. It's a really good example of adjusting these trades after earnings, not to potentially make a profit, but to actually reduce risk and reduce the potential loss by hedging and rolling down each end of the trade. So again, be on the lookout for that. Amazon was the one that we had here today. This was just the last side of the trade that we had, the butterfly that didn't get closed out yesterday. So we, again, bought back the 360, 355 put spread, almost close to max profit at a 470 debit. So it took a nice hefty loss of 360 on this one. UPS, about the same story. We had originally sold a 197.5 put spread and took in a nice credit for that one. That looked like a really good trade until the market kind of fell apart, but that's again why you trade small position sizes. And so today we bought back the 197.5 put spread for a 250 debit, which is exactly max loss. It was the only way we were able to get the order through the market. So you can see we try to get those orders through at near around expiration for a little bit less than max profit. So Amazon in this case, max loss. So in this case for Amazon, max loss was $5. We got it back for $4.70, so we saved $30 on the whole trade, closing it out. For UPS, you'll notice that we didn't actually get it. It was just so far in the money that we had to, really kind of bait somebody into getting out of this trade for us, so we had to do it at max loss. But sometimes you'll have to do that, and again, the key here is that you want to just get out of the trade. You don't want to be in a position where you possibly get assigned, because that's going to cost a lot more with commissions to do that. And then finally, Tesla. Tesla is one that we actually closed out early. This is a March credit spread that we had. It was the 170, 165 put spread. So we were trading below the market. And again, if you remember back to that video tutorial that I did on Tesla, is I didn't want to get in the way of this train wreck that is Tesla going higher. And I do think, and I don't mean train wreck in that sense, I mean it's just been nonstop, very consistent moving higher over the last couple of months. So at the point at which we actually entered the trade, Tesla was actually riding really high. It had, kind of almost peaked in its chart. And what we didn't want to do was get in front of that. And I'm glad we didn't, because earnings came out and Tesla has just continued to move higher. So today, with the big pop in Tesla, obviously, this put spread really, really dropped dramatically in value. And so what originally was a very, very nice trade, we actually closed out today with a nice hefty profit of 105 per spread. So we bought back the 170, 165 put spread, and we did that for a 35-cent debit. Again, there's no point in letting this thing ride all the way to March expiration, so another 30 days just to get 35 cents out of this thing. At this point, we've made the vast majority of the potential profit that we're going to make on this trade, so why not just close out the trade and move on to the next one? And you'll notice here on the chart of Tesla that obviously this thing just continues to move higher. It's just been very, very resilient. But at this point now, there's no use in entering any new trades on the put side, because implied volatility is back down below that 40 or that 50th percentile that we look at. So at this point, if you're interested in trading Tesla to the higher side, because I know a lot of people had comments about that today, a lot of people were tweeting me about that, then I would suggest doing some sort of call spread, call debit spread, because right now implied volatility is not high enough to be selling any more put credit spreads in Tesla. So again, if you're interested in doing that, you want to do a call debit spread in Tesla and take advantage of the move higher that way. So as always, I hope you guys enjoy these videos. Tomorrow should be really interesting as we wrap up the expiration week, and then we'll be very, very heavily into March and April options. As always, please add your comments below here. I will get back to those tonight and tomorrow before the market open. Happy trading.